I think the Fed is trapped in a kind of a conundrum here because they really need to fight inflation. They know they need to fight inflation way above their 2% target. It's been above their 2% target for over 3 years. It's rising further away from that 2% target. It was 2% prior month, and then this latest reading showed 3.5% year-over-year growth, which is way above their 2% target, as I said. But it's rising from a rate that's already bankrupted the middle class of the country. They say inflation was up riding at around 9% at the peak, came down to 3.5%. All right, big deal. Have a party. Congratulations. But in the interim, 78% of Americans are living paycheck to paycheck. The cost of food is up 37% in the last couple of years. 50% increase in home prices. So you priced out home ownership just when you deal with the price of the home. Forget about when you add in maintenance and taxes and insurance. So, I mean, they're doing a victory lap because they're pretending that, if you take out this and if you take out that and if you take out, owner's equivalent rent, if you take out this thing that went up, then, we reached our 2% target. Well, why don't you take the things out that went down and make inflation even hotter, Anthony? I mean, it's just ridiculous. Inflation is rising at a very rapid rate vis-a-vis their target, and it's rising from a level that has already bankrupted the middle class of the country. So congratulations. We're doing a great job. They know that their 5.25 to 5.5 Fed funds rate is too high a rate when you have an insolvent nation, when you have a $20 trillion of household debt and over $20 trillion in business. 40% of the Russell 2000 doesn't make any money. And credit card debt is at $1.3 trillion. And auto loans are being defaulted at a very rapid rate. Personal bankruptcies are soaring. So they have to pretend that they're successful because 9 is higher than 3.5. But the fact is that they've done a great job of destroying the American middle class. So congratulations. The economy was growing at 3.5%. So in Q4 of last year, in Q1, it dropped all the way down to 1.6% seasonally adjusted annualized rate. We just got the April ISM, Institute of Supply Management surveys, and that showed that the service sector of the economy went into contraction after 15 months of expansion. The manufacturing slipped back into contraction too. So according to the Institute of Supply Management, both their surveys, the service sector and the manufacturing sector is in contraction. You look at the National Federation of Independent Businesses, they're warning really dire things ahead for the consumer. Look at consumer confidence. The economy's not plunging off a cliff right now. I'm not claiming that, but you asked me if it's strong. It isn't strong. We're bouncing along the bottom. Most of what you're reading or seeing in reports like retail sales, how great the retail sales were. That's a nominal number. I mean, when food prices are up 37% in the last couple of years, the Wall Street Journal calculated that, a basket of food. I mean, has your income jumped by 37% in the last 2 years? Mine hasn't. I don't think hardly anybody's has. The consumer's falling further and further behind. And you can't have a healthy economy when you have a frozen middle class and a frozen transaction market in housing. Real estate is frozen. Things aren't working that well. I think they're working well for parts of Wall Street, right? AI stock, maybe. But other than that, it's not a disaster yet. Could be heading that way, but it's certainly not anything to write home about. If you look at things like industrial production, flat, it's really not a great economy. It's just okay at best. China is just okay, hanging on. I mean, you have GDP is population growth, actually more specific, labor force growth plus productivity. Productivity's rate of change is falling. The U.S. has very slight population growth. China has negative labor force growth. So, Europe is suffering from depopulation. So, like I said, we're bouncing along the bottom. But the problem I see coming is that finally engendered this inflation because you went down the road of helicopter money, printing trillions of dollars and handing it out to people. And now you have this inflation problem that you have to fight. But if you fight it, what else happened when you took interest rates? Like the 10-year note in the United States went to 0.33%, 0.33%. It's a 10-year note. And that caused a lot of people to go out and buy lots of things, borrow lots of money and buy lots of things. So, everybody I know has, multiple houses, at an interest rate that's 2-3%. So that's wonderful while it's happening. But now you say, okay, well, now mortgage is going to cost you 7+%. And the price of the home is, $1,000 a square foot here in Naples where I live. There's a very limited number of people that can buy that house and afford the insurance and the maintenance and the taxes. My insurance cost in my house went up 70%, 70, without a claim. The house didn't change in price, 70%. The problem is, like I said, a tremendous amount of debt, unprecedented asset bubbles, and now you have inflation that's becoming intractable. So what does a central banker do? The banks park their excess reserves in a reverse repo facility because they wanted to get that extra interest. If it becomes clear that the economy is slowing, I believe that the Fed will think about lowering interest rates. And when you reduce interest rates, bond prices go up. So I think banks will say, okay, I want to now buy bonds with these excess reserves to capture that extra yield and principal appreciation before the rates go down, because the Fed will lower the interest rate they pay in the reverse repo. So that money will come out of there and it'll be very stimulative to the economy for a short term. And then once it's out, it's out, and there's nothing new coming in. So not from a stock basis, but from a flow analysis, that's going to be very negative for growth and liquidity. Here's where you get in problems. You start guessing, what if the Fed said bond? What if OCC and the Office of Thrift Supervision and the Fed, they changed the rules where banks can buy unlimited amount of bonds, wouldn't count towards their capital ratio. That could spur a lot of buying in bonds and creation of new money. So you get into trouble thinking, what if the Fed launched another bank term funding program? Why wouldn't they? They can just do that and bail out the banks. Or what if Janet Yellen and Powell get together again and launch another round of helicopter money? Those are the things I think they will do, but that's in response to an economy that is crumbling. So how much they do and what they do is why you can't just say, well, I have my money with XYZ broker dealer and I'm in a target date fund and I'll be fine because the stock market always goes up. Well, no, the stock market doesn't always go up, and it's gone down for over a decade in this country. It's gone down for decades in other nations, other economies. What do you own? And do you overweight bonds or do you short bonds? Do you own high volatility stocks or low volatility stocks? Do you own the dollar or do you short the dollar? Are you overweight commodities or you short commodities? That's what I do. I can predict the problem and I could understand what they do to combat it, but a lot depends on what the government's response is, and I will adjust my investments according to what the government does, how much they are willing to interfere. And here's the caveat for you: if the Fed intervenes and the Treasury intervenes like they've done in the past since 1987 with basically some fiscal and monetary stimulus, they've always done that in an environment of deflation, persistent. So the zeitgeist has been deflation or disinflation since 1987. They'll do this next round of fiscal and monetary intervention when the problem is inflation, stagflation, inflation, intractable. So that poses a whole problem for the bond market, because if they come on the other end of this with another round of helicopter money, what happens to long-term rates? Very, very well possibly be that they rise instead of fall, and then there's going to be no healing for the economy whatsoever. Right now, we're positioned for a stasis. So I have a 5-sector inflation, deflation, economic cycle portfolio. Now we're on sector 3. So, it's not the end of the world. Sectors 1 and 2 are when you really have to become defensive. I'm believing that the reverse repo facility will run dry around July, but we'll see. I mean, the pace of that decline has attenuated significantly in the last couple of months. That's where a lot of this liquidity has come from. But if I'm correct, and that happens this summer, where the reverse repo runs dry and we keep recycling this debt at 5.3% plus, because I don't think the Fed can really cut rates more than once before the election, maybe twice before the end of the year. And you remember under Ben Bernanke, when he finally realized that, hey, we got a housing bubble here and banks are in trouble, and we're gonna have to cut rates. He started cutting them in the summer of 2007. He didn't get to zero until the end of 2008. That didn't stop the carnage. So what's going to happen is going to happen, regardless of tapering QT and cutting the Fed funds rate to 5%. It's not enough. So we could be the next condition could be recession, disinflation, and deflation, and there's a totally different investment dynamic surrounding that.